Well, hey everybody, Rob Satcham from FeedbackWRENCH here, and today we're going to be looking at the S Corp versus LLC. How much self-employment tax can you save with an S Corporation? So if you become an S Corporation, how much might you save in taxes? Just how low can that salary go? That's the big question for everyone doing an S Corp. So in this video, I'm going to be showing you some of the specific scenarios and examples that can help you understand the types of tax savings you might experience by becoming an S Corp at various levels of income. These examples are fictitious, they don't give you the whole story. It's every business owner's job to consult the 74,608 page tax code, or just hire an accountant to help you do it. This is not legal tax advice, nor are we responsible for any repercussions there may be from implementing this advice without professional or qualified help. We're going to show you strategies and tactics that can make a ton of sense, but you need to make your own decisions according to the tax code. So all that being said, let's kick this off. Hopefully, you've watched our video called The Tax Difference Between an S Corp and an LLC, which is meant to cover a lot of the basic S Corp and LLC questions, and that link is in the description below. And not only should you have watched that video, but then you must watch our other video, walking you through the 3 major drawbacks of an S Corp. An S Corp is an amazing tool, but you definitely need to be aware of the drawbacks and potential problems, so check that video out as well. You need to be aware of these things. All right, now to show you how much you could expect to save if you were to convert to an S Corp, particularly from an LLC taxed as a sole proprietor. When you become an S Corp, the main idea is that the corporation will be paying you a reasonable salary, and then you'll also have an owner's distribution or a dividend or a draw. There's different names for it. The income is split into those 2 parts, the salary or payroll amount, and then the owner's distribution. The salary is subject to the self-employment taxes while the distribution is not. That means that the distribution or dividend or owner's draw is highly tax efficient because it's not subject to the 15.3% self-employment tax. Self-employment, if you remember, is a combination of Medicare taxes and Social Security taxes. The payroll or salary side is taxed at a full 15.3% up to the Social Security limit, which for 2017 is going to be moving up more than 7%, increasing $8,700 to a threshold of $127,200 from $118,500 in 2016. So the Social Security limit for 2017 is or was $127,200. This means that all of your income on the salary or payroll side up to that Social Security amount of $127,200 will be subject to the self-employment tax, so that's Social Security and Medicare, 12.4% for Social Security and 2.9% to Medicare, equaling the 15.3%. Besides that 2.9% Medicare tax, there can be additional Medicare tax when your income is above a certain level. So just be aware that for married people earning $250,000 and filing jointly, or making $125,000 filing separately, or single filers earning $200,000, you need to pay attention to the additional Medicare amounts. Since only the salary or payroll is subject to the self-employment taxes, the goal would be to take only as much salary as is legally required, but nothing more. The lower you keep the salary, the more you save in self-employment taxes. That is the great dilemma for business owners. How low of a salary can you take? On one hand, you'll hear advice telling you that you should be paying yourself what you'd make at another job doing this, except for that whole problem that you're a small business and the net profits might be totally different than the corporation that someone else is working for doing the same job for that large corporation. Then you have others that would say to you to be deciding your salary amount based on a percent of your net profit, adjusting the salary as your business fluctuates. And then you'll have others that use more complicated methods. Here's what I've observed. The IRS has had lots of cases to set the precedent, and you want to make sure that you're making an informed decision here. There's no absolute correct answer here, except for that the salary should be reasonable, and that your accountant can help you make an informed decision in order to mitigate the risk of being audited and having your salary get reclassified. Reclassified is not a good thing. Imagine you go through a couple of years being too aggressive on this, and then suddenly have multiple years worth of distributions where you didn't pay self-employment taxes get reclassified as wages, and you'd be forced to pay the 15.3% SE tax on those, and then penalties and interest. That can be an ugly wake-up call for most people. So talk to an accountant. Make sure you have great bookkeeping. That's the foundation of all this. Get a tax plan and wise accountants giving you advice. I highly recommend nuancefinancial.com for this. They're based out of Minneapolis. They have a monthly service where they will do all your bookkeeping, provide all the payroll, give you a tax plan, and do your taxes all together. And they are trustworthy and amazing at what they do. What an accountant is likely to do is to teach you that there are many different tensions that you need to manage when deciding this salary. And it's not a hard or fast rule. The first tension is your net profits. If you don't make money, why would you pay yourself large salaries? That doesn't seem like it makes sense. Next would be your industry norms and previous salaries. You should probably consider the industry when you decide on how low of a salary you dare to take. Then you have to measure your risk. If you have lots to lose here and you're making lots of aggressive tax planning tips, you want to be sound in how you make this decision in particular. In just a bit, I'll share what I've learned. Many tax planners advise their clients on how low of a salary that they dare take in an S Corp. But real quick, I want to show you how much you might save in self-employment taxes if you were to do a 50-50 split at different levels of income. 50% salary, 50% distribution. I'm going to show you things here that aren't complicated math. So I don't mean to offend anyone and act like you're stupid or insult your intelligence here, but if you had net profits of, let's say, $30,000 and you chose to do a 50% salary and 50% dividend, you'd save about $2,300 a year in self-employment taxes. At that $30,000 mark, you'd be making about $2,500 a month, and instead of paying about $382 a month in self-employment taxes, you'd lower that bill to about $191. At $75,000 in net profits, with a salary of $37,500, you'd save about $5,700 in self-employment taxes. So at that $75,000 mark, you're making $6,250 a month, right? And you'd go from paying $11,400 in self-employment taxes a year, or $956 a month, to paying about $478 a month. Huge savings. And at $110,000 in net profits, you'd be saving $8,400 a year in self-employment taxes. At that $110,000 a year, you're earning about $91.60 a month. And you'd go from having $16,830 in self-employment taxes, that's $1,400 a month you'd be paying as a bill, to be paying only $8,400 a year, or $700 a month in self-employment taxes as a bill. Now, that's the actual savings you'd see, but that doesn't really tell you the whole story, because you need to consider the opportunity costs of that money. Remember, opportunity costs tell the story of the money that you could have made if you had that money and you invested it in various ways. Let's look at the opportunity cost if you would have invested those tax savings into the stock market. If you invested these amounts in an S&P 500 index at Vanguard, I really like Vanguard.com for investments, earning about 8% a year for 25 years, this money really adds up. Let's take a look at this. 8% invested monthly over 25 years. So at that $30K in net profits, you would have saved a total of $114,600 over 25 years and have an investment account of $173,617. At the $75K in net profits over those 25 years, you would have saved a total of $143,400 in self-employment taxes. Then you'd have an investment account of $452,800 after 25 years. And then at that $110,000 in net profits, you would have saved a total of $210,000 in taxes. And if you invested that $700 a month, earning 8% annually, you would have turned that $210,000 savings into $663,000 in an investment portfolio. It can really pay off to do this S Corp thing. Those scenarios are using about 50% of the net profits as salary. But is that the lowest you could go? Tax advisors are all over the place on how low they think you can go with your S Corp payroll as a percentage of net profits. This example was 50%, but some might tell you that they think it should be a certain dollar amount for what you do, and some would tell you that it's a percentage, maybe higher or lower than 50%. You'll hear everything out there. Here's what I've personally heard. Major CPAs, very public and famous CPAs, teach about what percentage you could use as a salary. I've heard them teaching their clients to be really aggressive in their S Corp. Within reason, obviously, and weighing the risk. But their advice is to never take less than 1/3 of the net profit as a salary. Did you hear that? Never take less than 1/3 of their net profits as a salary. That's right. There are CPAs all over the place that would look you right in the face and tell you that you should shoot for taking 1/3 of your net profit as a salary, and the rest should be a distribution. This isn't my legal tax advice, but I'm telling you, this is the type of thing thousands of business owners are doing. I've even heard some go as low as 25%, but I think that's too low. But let's play with that 1/3 number again here. Now, if you were to take that 1/3 as a salary and invest the savings, just the savings for 25 years in an S&P 500 index fund at 8%, here's what you might see. At that 30K in net profits, you'd see savings of about $3,000 a year or $255 a month. You invest that $255, you would have had $76,500 in savings, and that portfolio would be $241,600. Now, if you had 75K in profits, you'd see savings of about $7,600 a year. That's a savings of $637 a month. Pop that in an investment account, 25 years, 8%. You'd save $191,100 total in self-employment taxes, but your investment account would be $603,000. And at $110,000, you'd see savings of about $11,200 a year. That's $935 a month in savings. After 25 years, you'd have a portfolio of $885,000, and you would have saved $280,000. Obviously, things vary for every company. I'd love to hear CPAs. If you're a CPA or a professional or a tax person, put in your 2 cents down in the comments. Let us know what percentage you think, or give some great advice to people. People read those comments. I'd love to see that. And obviously, investments can vary, but folks, you can save massive amounts of money in an S Corp, but remember, there are drawbacks that you need to know about. And you should watch our video about the 3 drawbacks of an S Corp, and that's in the description below. Thanks for watching our video. Please stay tuned for more, and please subscribe to our channel. Turn on alerts, and we really appreciate your time.